Thank you so much, everybody, for tuning in to our webinar today, where we are talking about private loans, private money loans being simplified. Let me share my screen and then we'll kick it off. Apologies for the delay. We had some technical difficulties, but that's okay. Here we are. All right. Sheri, you can see my screen, right?
Yep. Gotcha.
All right. Okay. Thank you so much, everybody. I'll introduce myself in a second here, but we are going to talk about Private Loans Simplified with our very special guest, Sheri Duignan. Did I get it? Did I get it right? All right, cool. And then I will introduce Sense Financial and myself just very briefly, and then I'm going to get out of the way and we're going to let Sheri do her thing because this is her specialty and her time to shine, and we're going to let her do that. But I am Brett, and I'm a self-directed IRA solo 401k consultant here at Sense Financial. My contact info is on the screen. And just to give a little disclaimer, we are not a fiduciary. We're not providing legal or tax or accounting, investment, or any other professional advice. If you need such advice, please seek out that proper professional. Also, this entire webinar is educational only. Okay, we want you to be armed with knowledge to make an informed decision about how you can invest both personally and potentially inside your retirement account. So a little bit about Sense Financial. You may know us, you may be an existing client, you may be a prospective client, and you may have never heard about us at all. So I'm gonna kind of give a high level on what we do. We have been around since 2010, and since that time we have been a boutique firm specializing in self-directed retirement accounts with checkbook control. These plans are pretty simple. We do a self-directed checkbook IRA, or we do a self-directed individual solo 401k, and those are the only two products we specialize in. Because of this, I think we do it at a pretty high level. We have 5-star reviews all over the place. You can check those out. And actually, these numbers are incorrect. I need to update it because we've, to date, currently are over 7,000 clients helped establish well over 9,000 different types of self-directed retirement accounts. And most of our clients come through referrals. Most of those referrals come from our existing clients. And I think that's another testament that we have done our job to wow and delight and even help our clients to the point where they want to send their friends and colleagues over to us. So real quick, what are the benefits of the self-directed IRA and solo 401k? Well, the whole point is investing in alternative assets. So we think that this gives you what's called true diversification. Okay, so most of us are used to investing our IRA or 401k into Wall Street, a mutual fund, individual stocks, ETFs, bonds, money market, whatever. That is the more traditional side of investing that we're all fairly familiar with. And this conversation about self-directing using one of our plans is not it's not an or, it's an and. Right? We want you to have true diversification. Keep money in the stock market. Invest in real estate using your IRA or 401k as well. It's all good. That's the whole point of self-directing, is choosing what you want to invest in. The returns can be tax deferred in a traditional type plan, whether it's 401k or IRA, or they can be Roth, right? The question is, do I want to pay taxes on the seed, or do I want to pay taxes on the harvest? So if you're ever contemplating whether you're going to focus more on growing the Roth portion of your retirement, that's the question to ask yourself. I can almost promise you that your future self will thank you for paying the taxes on the principal contributions when you were younger than when you're older, okay? So just kind of bite that off and chew on it for a little bit. Again, I'm not giving you financial advice. This is just the fact of the difference between Roth and traditional. And you actually can get a loan, okay? We're gonna talk about lending using your retirement account today and even your personal money. So everything we talk about could be done with personal funds or with a self-directed retirement account. And you can also get a loan for the retirement account, right? So if you want to buy real estate, you can get what's called a non-recourse loan, and you can put 30 to 50% down. Your IRA or 401k can put 30 or 50% down, and you can get a loan for the difference, okay? When's the last time someone offered to give you that for buying more S&P 500? I know you can do trading on margin and stuff. That's not what I'm talking about here. This is totally different because it's a hard asset, right? And that, by the way, I'm going to get off my soapbox in a moment, but that is the difference between self-directing and just putting your money in the stock market. When something is tied to a hard asset, you know what happens if there's an issue with the loan payment, so to speak. There's a default that occurs. There's a process of your retirement account or you personally being made whole by going through a foreclosure process because it's secured to a hard asset. In addition to that, because you're doing something that involves another human, you get what I like to call a more predictable result. I'm not going to use the word guarantee, even though I just did, but it's as close to that as it possibly gets because two people are signing on the dotted line. You on behalf of your IRA or 401k or your own personal money, and the borrower, and everybody's agreeing to terms. Okay, I'm not going to steal Sheri's thunder here, but that is the difference between throwing your money in the stock market and self-directing. That's one of the differences. With checkbook control, you can bypass the custodian, which means you can actually write the check, you can sign on the dotted line, you can do a wire transfer, you control the funds that are invested in your retirement account instead of having to go through a custodian and all the red tape and transaction fees per asset fee, et cetera, that comes along with that. Okay, so we avoid all that with the checkbook control. And then the solo 401k it really is a true tax shelter. In fact, I need to update that number. 77,500 is 2025 if you're 50 and over, 70,000 otherwise. But that's actually gone up this year to 72,000, and I think 80,000 is the number now for the solo 401k. So it's literally 10 times the amount of an IRA that can be contributed on an annual basis. We call that the ultimate retirement plan. And then I've kind of already hit on this, but virtually unlimited investment options. In fact, the IRS only tells you what you can't invest in, which is collectibles, life insurance, and an IRA. And any transaction involving you or your immediate family needs to be stayed away from, okay? Otherwise, the sky's the limit. Crypto, precious metals, private lending, commercial real estate, residential real estate, tax deeds, trust deeds, private businesses. The sky is almost the limit, all right? Now, with that, you get what's called true diversification. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And that is true, and that's what we're talking about here, okay? We're going to talk mostly about private lending today, but again, you have all these other options to consider when you're self-directing. With that, I'm going to introduce our guest today, and then I'm going to get out of the way. By the way, please put questions in the chat as you think of them. If there's some that are relevant that can't wait until the end, I'll answer it in the chat, or I'll interrupt Sheri and we'll answer it right there on the spot. But it'd be great if we have a list of questions to go through once we're done. And we will give at least 10 minutes for Q&A, if not longer. And so encourage you to do that. All right. Sheri is a private money lender, real estate investor, and capital partner who has funded millions of dollars in short-term investment loans for high-volume fix and flip and rental investors across the country. She began her investing career more than 20 years ago, first as an accidental landlord, then as a home investors franchise. By the way, those are the We Buy Ugly Houses people. Yep. Flipping and wholesaling homes in Orange County, California, and Atlanta, Georgia. Over the years, she expanded into short-term rentals, multifamily, and ultimately discovered the power of private money lending. Today, Sheri is the founder of Opportunity Enterprises, LLC, where she helps investors earn passive returns secured by real estate through private mortgage lending. She also teaches others how to become private lenders themselves through her workshops and mentorship programs. Her mission is simple: help everyday people turn their idle or retirement funds into passive income backed by real estate without the headaches of being a landlord. Audiences love Sheri for her clear, simple explanations, real-world case studies, and ability to make private lending feel accessible, even for complete beginners. All right, Sheri, take it away.
All right, I'm going to share my screen here. Give me 1 second, sorry.
No, you're good.
Let me find my screen. There we are. All right, can you see this? Okay. All right, are you able to see it?
You know what? I don't. Okay, somebody gave a thumbs up, so I'm going to go with it because I can't see us for some reason, and I can't see the screen that you're sharing, but let's roll with it. If they can see it, that's all that matters.
Okay. All right, I hope so. All right, so just quick disclaimer as well on our part. Before we get started, just I am not an attorney. I'm not a CPA. And I definitely advise you to always consult with your self-directed IRA or 401k custodian whenever you're getting into these transactions, just to make sure that you're doing them the proper way. Okay, so that's kind of my disclaimer. And obviously, Brett already did a great job of introducing me, but I will say that, I accidentally stumbled into private money lending first as a borrower. So I was flipping houses out in Orange County, California, where you're buying $500,000 to $700,000 fixer-uppers and putting, a couple $100,000 on top of that into them. So in order to do the volume I was doing, I needed to use other people's money in order to purchase those properties. And so I was a borrower well before I ever became the lender. And it wasn't until I actually moved back to Atlanta. I moved in 2020 back to Atlanta and realized that I had to flip probably 5 times as many houses to make the same money out in California, because you're buying $40,000 houses out here. And that's when I started looking at the HUD statements of the money that I was making being out there flipping the properties and what my lenders were making, and just a light bulb went on. My lenders, from the comfort of their home without having to go out and manage contractors and all of that, were getting a predictable return. They did not have any kind of construction risk. They didn't have any project management to do. And they were able to make sometimes close to the same returns I was making. So I decided I was on the wrong side of the equation. So I went from borrower to lender. And I started out just lending my own cash, and that worked great until I ran out of money. And it seems like no matter how much money you have, you always seem to run out. So I discovered obviously the ability to use a self-directed IRA. So I am a client with SenseFinancial, and I use those self-directed funds to do a lot of my lending, and that's kind of when everything changed. I actually ended up selling my franchise and got into lending more full time. So let me kind of just cover quickly what is private money lending and kind of how it works, because a lot of people get a little confused. There's private money and there's hard money. In essence, they're very much the same. The difference between private money and hard money is typically hard money when you're speaking of traditional hard money. It is through more of a traditional institutional type setting, and not just an individual. So private money can be anybody. Anybody who has capital can actually be a private money lender. They do need to only fund business purpose loans. We are not able to do any kind of lending on owner-occupied type properties. So anything that's, you're buying your own private money, private residence, that something falls outside of the scope of what private money lending is. So the borrower is typically an investor. Typically there's somebody that's looking to do a fix and flip, possibly buying a rental, even multifamily properties as well. And the lender would then take a look at the property, look at the deal, look at the borrower, do all the underwriting, and then they can determine whether or not they want to fund this loan. And the beautiful part is we're able to set our own terms, okay? So we can set whatever type of interest payments we want, how much we want as far as origination fees, whether we want monthly payments or lump sums. So basically think about it as being the bank, but without all the bureaucracy. Whereas hard money, they are a little bit more bound to their set terms of, this experience equals this interest rate. We have more flexibility to offer a little bit more customized loans to our borrowers. The other idea is also that we probably are a little bit faster. Hard money is still a little bit more institutionalized and does sometimes take a little bit longer to get funded. So with a private money lender, you can generally get those funds a little bit faster. So why self-directed 401ks and solo 401ks and IRAs are such a powerful tool for lending is there's huge tax efficiencies to lending in your IRA. The downfall of lending with your personal money or through a company is that that is pretty much 100% taxable money. So when you're doing loans, out just using your, if I was just doing my own personal money, I have to pay, obviously income tax on the earnings that I'm making through those loans. And so obviously if you're doing your lending out of your solo 401k or your IRA, you don't have to, you can defer those taxes obviously. And again, depends on whether it's a Roth or not. But you have the benefit of doing that in that avenue. And maybe what you do with your personal funds is invest it in real estate as maybe more of a landlord, where you do have other tax benefits that come with using funds as a landlord. Okay, but it is passive income without actually being a landlord. So you don't own the property; you're just lending on it. There's no tenants, there's no toilets, no midnight phone calls. So it's the most passive probably you can get. There is obviously, you got to make sure that you're getting your payments on time, a little bit of due diligence with that. So real estate is the collateral. So you are getting something that is backed by, something that has intrinsic value. So you have a lien against that property, whereas stocks, they could crumble overnight, right? Land, it doesn't disappear. So even if the property itself doesn't have a lot of value, the land will. So you have something that will always have some type of value associated to it. And then, speed. So with private money lending, your money is not being tied up for, 3 years, 5 years, 10 years. If you're being a landlord and you're buying rental properties, you're possibly going to have to keep those properties for several years. With private money, you can keep turning your money. So you have that kind of velocity of money and being able to keep turning that. Every time you do a new loan, you have the opportunity to not only get interest, but you're getting potentially origination fees and other fees that are associated with it. So you can compound that money, and it's all going right back into your 401k. And then intelligent diversification. So Brett was kind of touching on this. It's not speculative investing. I mean, there is an asset-backed piece of property that you're doing your due diligence on and you're making sure has value. It's income from day one. As soon as you fund the money, you're starting to get your interest in all of that compounded inside the property, versus waiting for a rental property to possibly appreciate over time. That's a little bit more maybe speculation. Again, just always make sure that your IRA or self-directed 401k is the lender on record. One thing that you want to make sure of is that you're not putting your personal name if you are lending out of your retirement account, because you want to make sure that there's that clear separation. And you can't lend to the disqualified person. So you can't lend on like your own flip. So if you are a fix and flip, you're out there doing fix and flips, you cannot lend your money from your solo 401k or IRA into your own flip or your spouse's and certain other family members. So again, I always encourage you to reach out to your custodian and your advisors and make sure that you lean on them as far as what you can and cannot lend on. But it is a powerful tool. It's one of the best places to do this private money lending. So a lot of people always ask, obviously, what are the interest rates and returns that you can charge? It really depends on your risk tolerance, the types of loans that you're lending on. But interest rates can be, I'd say, generally somewhere between 8 up to even as high as 18%. If you're working with a very inexperienced borrower, you're generally going to charge a higher, like 15, maybe even again 18% on their loan. If it's like a fix and flip that they're going to hold on to as a rental, so it's going to be a longer term play, then you might be closer to that 8%. But as a private money lender, you set those rates based on the property, area that it's in, and that risk that's associated with it. So if you're lending out a $100,000 loan and you want to do that loan, generally our loans are 6 to 12 months. You're making 12% return. You're going to get $6,000 in interest income over the course of that 6 months. So on top of that, that, potentially you might be charging some points. So you might get 2 points, which is another $2,000 for a total return of $8,000 over that 6 months. And the idea is, again, that speed and velocity of money is now all that goes back into your IRA. You take all of that and now you can relaunch it into a new loan and continue to compound that money. All right, so 3 things that you must do to protect your money. So always the big question is, how do I ensure that, my money is protected? The first and most important part is doing proper vetting. So you want to do due diligence on not only the borrower, but the market and the deal. So a lot of people will look at the deal, maybe not as much at the borrower, and a lot of times they don't even look at the market. But just to give you an example, if we're doing a fix and flip maybe here in Atlanta versus a fix and flip in, I'm going to say Fort Myers, that Cape Coral, Fort Myers, Lee County, Florida, they got hit hard with hurricanes and a bunch of other things over the last couple of years. And inventory in that market, I'm just flat out, it's true, is sitting for much, much longer. So things aren't selling right away and values are actually coming down in that particular market. So if I'm doing a loan on a single family home here in Atlanta, that's a $300,000, it's got an ARV of $500,000, I might charge allow for a loan at a totally different value than I would in Cape Coral or Fort Myers, Florida, because I know that value of that home over time while they're fixing it up may be coming down and I don't want to lose money. So it's important to understand the market, the days on market that it's taking to sell things, and kind of what's happening in that area. And are there risks? Are there hurricane risks? We might need additional insurance, flood risks, things like that. And then you do want to know who you're lending to. So credit matters. Experience, whether or not they actually have assets. Generally, when I'm making a loan, I want to make sure that not only am I looking at the property that the borrower is working on in the specific deal, but I want to make sure that they have their own assets that should things go wrong and we have to foreclose, that maybe that property, if it loses value, they have maybe other assets we could maybe cross-collateralize or go after. So you just want to make sure that you're working with a reputable borrower, that they have experience. It's okay if they don't have a ton of experience. Again, you're going to set your rates based on that information. And then you obviously want to have a very clear understanding of the deal. One of the most important things that I think people don't look at when they're looking at a deal is whether or not, what kind of leverage is maybe already on the property. Sometimes you'll get people that are coming looking for a loan and they just want renovation funds. Maybe they already own the property. And in that case, we want to make sure that we understand what current liens might be on that property. So we want to make sure we're doing title searches, make sure there's no outstanding liens or anything encumbering the property. And if there is another lien, we would be then in what we call second position, which is a riskier position. Therefore, we'd probably need to charge higher rates. And we want to make sure we're not over leveraging that particular property when we're putting in our loan. So all those factors need to be assessed and taken into account in order to make sure that you're doing a good deal and your money is protected. So again, looking at the borrower's experience, we might ask for like 2 or 3 of their most recent HUDs. We generally like them to be within the last 1 or 2 years is what I ask for. What their credit scores are, and that just shows who they are kind of as a person and how they pay their bills. And maybe some references of other lenders that they've worked with, and were they on time? Did they make payments? Did they get made whole? Were they paid off? And then obviously for looking at the deals, we want to look at how much leverage we're actually getting into. And then you want to make sure that they have a proper exit strategy. How are you going to get, repaid on this loan? I get a lot of people that come to me with loans and I'm like, okay, I can give you a loan for 2 months, but what's your exit strategy? Because they're using it to buy something and they're going to have a plan to then refi in order for me to get repaid on my loan. And so you want to make sure you understand fully the entire exit strategy. If it's rental income and they're going to keep it for a long period of time, know that that's obviously going to be a longer term loan, and you just want to make sure that you're prepared for those kinds of things. So you want to make sure that you're definitely spending your time doing that due diligence. As far as like securing your investments, the best thing to do is first, with your borrower, you want to make sure you're getting a copy of their operating agreement, because you need to know who's signing. This is one of the big mistakes I see people make is they start, working with people, and they may not even be the proper signer to be able to leverage this property for that LLC or whoever you're working with. But you want to make sure that you're using the proper paperwork. So that generally the proper paperwork is going to be a promissory note. So that promissory note is probably the most important part, second most important, I'd say, that outlines all the terms. So think of it like the mortgage. It explains the interest rate, when the loan will be funded, whether or not payments will be made, at what interest rate, if there's any kind of late fees on any payments. It spells out all of those terms within the promissory note, or we can call it kind of a loan agreement. Okay, in essence, they're kind of the same. So with that promissory note, that is it does not get filed. Okay, one of the biggest things people think is that gets filed down at the, the court. And that piece is not. So that is something you want to hang on to the originals, have them signed through title and escrow, and then have them send you the originals, and you hang on to those. And generally, you're supposed to turn those back in when the loan is repaid and you're signing off on a what they call a satisfaction of mortgage or deed. And so you want to make sure you have your promissory note. And then on top of that, I generally get a personal guarantee. So this is, again, where outside of the LLC, if the LLC were to get dissolved, you're getting a guarantee from the owners within that LLC that they will cover the note beyond what the LLC, is responsible for. It's worth what it is. I mean, it's important to have one. Would probably require you to take them to court, but I would definitely recommend getting one in all these circumstances. Then you want to make sure that you're getting a recorded first lien position, some type of security instrument. So in some states, like in Florida, it's a mortgage. In other states, it's a deed of trust. Whichever state that you're working in, you just want to make sure that you're getting that drafted by a title attorney or a real estate attorney or a title company. And make sure, this is again another pitfall, and we're going to talk about this in a second, but that it is truly recorded, and preferably in a first lien position. So when you're doing private money lending, there's different positions, and it's based on the leverage and who gets there first, I guess you could say. A first position lien has the most strength when it comes to a foreclosure. So should something go wrong on the property, the borrower defaults, and we have to go through the foreclosure process, if I'm in first position, I am the first to get repaid of any other liens that are on the property. Generally, there's a few things that might, taxes and some of those things that may subordinate that, come first. But generally, if you're in first lien, you're going to have that position. If you're in a second or third lien position, if there is not enough money to satisfy the first, there's not going to be enough to satisfy the second or the third, and therefore you're going to be potential of losing your funds, and the first position would take over that property and be able to sell it and make themselves as whole as possible, and you lose. So those are things that you just want to make sure of, is what position are you in, and making sure it is actually fully recorded so that they can't go sell the property and not pay off the lien. You want to make sure you get a lender's title policy, and that's paid for by the borrower. Pretty much all the expenses associated would be paid by the borrower, and that the borrower's insurance is their hazard insurance. So just like your normal homeowner's insurance, they need to have that on the property, and you would be listed as the mortgagee or the first loss payee. So again, should a hurricane come through in Fort Myers, Florida, and wipe out the house, the borrower can't go take those insurance proceeds and run off to, California and not repay the loan. You want to make sure that you're added on there on that insurance, and they cannot cash that check without your approval. And then you want to make sure that you're closing through title companies and attorneys. Never wire funds directly to a borrower. There's maybe a few situations where you might do that once you've already closed on a property for draw funds. But generally, you always want to go through a proper vehicle of either a title company or a real estate closing attorney. And then having a clear draw schedule for renovation funds. So a lot of times when you're doing fix and flip loans, they'll come to you for a loan for say 150. They might be buying the property for 100 and putting 50 into it, or somewhere in that, those types of numbers. You're not going to disperse all 150 at the time when the property is purchased, because it's not worth 150 yet. It won't be worth that until after they've done all the renovations. So what you want to do is you hold back those funds, and as they complete their renovations in maybe $10,000, $20,000 increments, they're going to send proof. They're going to send a video walkthrough. They're going to send pictures, and then they're going to request the funds now be reimbursed, because now they've added value to your property and your collateral. Now you can give them more money. So it's really important to make sure you follow those kinds of things, because these are things that can get you in trouble where you're over leveraged on a property if something goes wrong. So common misconceptions I hear out there is that a lot of people feel that they cannot do private money lending, unless they're like a professional or they're, a business, and they need a lot of money. And so I'm here to tell you that anybody with capital can start. I started, and I did start in a risky position, generally lending funds in second position for like renovations, because I only had limited funds, but you can start. Tennessee, I do loans all the time where they're buying properties for $40,000 as the purchase price. So you don't need a ton of money to get started, and foreclosures don't always guarantee that there's a loss. A lot of people get worried about doing private money lending because they're worried about having to foreclose on somebody. And there's ways you can write into your promissory note that should they miss 2 payments, you don't have to necessarily go through the foreclosure process. You can do like a deed in lieu and take over that property. There's ways to mitigate that. But also, sometimes I have a loan actually here in Atlanta on a property. It's first position. It's the only loan on the property for $80,000, and the house is currently on the market for like over $350,000. So there's a lot of equity in the home. I'd probably make a lot more money if I actually had the opportunity to default on that particular property. Foreclosure doesn't necessarily have to mean a loss. It might just mean a little bit more headache, and now you might own a property that you didn't intend to own, and sometimes that's a good thing and sometimes it's bad. But these are some of the different common misconceptions. And then pitfalls. Again, just things that I've seen go wrong personally, myself experienced, or through some of the people that I've worked with and have tutored along the way. Sometimes they come to me because they've already been doing this on their own and they've maybe lost money. So the biggest thing is, lending in unfamiliar markets, or properties, types, multifamily when they're only familiar with single family. So not understanding the market, I think you have to be very familiar with the foreclosure laws. In California, it might take 1 or 2 years to be able to foreclose on somebody, whereas in some states you can foreclose in 3 months. So it's important to be familiar with those laws and know what you're getting into, because if it's going to take 2 years to foreclose, I need to factor that into my money, that if should something go wrong, am I going to be able to maintain not getting repaid and go through the whole foreclosure process? How much is that going to cost, and not lose a bunch of money? The other thing is usury laws. There's things in every state, they have specific laws that tell you how much you can and cannot charge when it comes to interest rates. So you want to be familiar with that so that you don't go out and charge 18% interest in a state where they say you can only charge up to 10. So just be familiar with those types of laws. And then obviously lending to borrowers without any experience or credibility, and maybe they don't have assets, and they don't end up being able to. They're not somebody that you can go after and get made whole if there's something going wrong. The other thing is not requiring title policies. I know a lot of people feel that that's sometimes not important. But I do have an experience with a borrower where not a property that I lent on, but another property he owned. And somebody came back after he put about $200,000 worth of renovations into the property and took him to court and said that he had no right to buy the property, that he was the legal owner of the property. So you want to make sure you have that title insurance because he did lose that deal, and you've got all that money into the property. So there's just things you want to make sure that you don't skip those steps. It's a couple $1,000s, and again, those title policies are paid for by the borrowers. So there's no reason to not get one. And then, mixing money with personal relationships. So again, try to vet your borrowers, and I would stay away from people that you have personal relationships that are going to ask for favors down the road and maybe not want to pay their monthly payments. And then funding directly to borrowers, again, just not having the proper recording of all the security deeds and things like that in place, and not having ample insurance coverage. So these are all things to, again, be mindful of when you're out there doing lending, so that you can keep yourself out of trouble and continue to actually make really good money. So again, there are risks, possibly the borrower defaulting, and, having yourself in a second position or third position, and, values going down. So it's just, there are risks with private money lending, but I tell you, it's probably one of the best investment strategies out there, in my book. So, anyway, here's some case studies. I want to get into some real life, deals, and some kind of, different lessons. Oops. So the first case study, this is an interesting situation because this was a brand new fix and flipper. They had actually done, I think this was their third, maybe fourth flip. Actually, I guess it was a third, because they had not actually fully realized any profits. In other words, when they came to me, they were in the middle of their third flip. The other two were still sitting on the market and had not actually sold yet. So there was no proof that they actually were going to make money on these deals. This was brought to me as a referral. Again, they had the two other properties under renovation. And so they were looking for $55,000 for a second position. It was to be able to complete the renovations on the property. And they were in sort of a desperate situation, and so they actually offered to give a flat, agreed upon, they were planning to make a lot of money on this deal once they sold it, but they needed the funds in order to get it there. So they offered a flat rate, agreed upon amount of $11,000 for a 3-month investment, and then they gave me like a per diem opportunity. And so this property did go long. We actually had it cross-collateralized on the other two properties, so we actually put liens on all 3 of the properties to ensure, since they were newer, just to kind of double insure our funds. When they paid it off, they did pay some penalties, but we got a $13,600 payout on that one. So 24% return on the money. Good loan. Case study number 2. This is a borrower. I've done several deals with this particular investor, and they were looking for purchasing land and a manufactured home, and they wanted to flip the manufactured home. So we offered to be able to fund for the land, and then they were going to get the mobile home for pretty much next to nothing, and the manufactured home was going to be moved. That was kind of the trick with them getting this property at the price it was, the home, to the land that we purchased. And so it was great. We paid a loan amount of $45,000. The loan term was for 3 months to get the property moved over there. 3 points and 15%. Because it is a manufactured home, it's a little more risky. Land is another thing that's a little more risky. This loan ended up being extended 2 times. They had issues with getting the home moved and then setting it up on the site. And then what we found out, or she found out, and now I know, that manufactured homes, if they've been moved from the dealer to a lot, once they're moved again, there's no longer any kind of financing that you can get on them. So had to be a cash buyer in order to sell this property, so it sat a lot longer. So on this particular deal, I ended up actually working a deal with the borrower, which I like to talk about this because this is the power of private money versus like hard money. is we renegotiated and we treated it as if it was a 6-month loan, since most of our loans typically are 6 months, and we only did one extension. We didn't end up like gouging them on extension fees. And so on this particular loan, we ended up earning total points and interest $9,112.50 over 9 months, and a pretty good return there. And then this was a partnership that I did. So I had a doctor. He had come into some funds selling part of his practice. And so we partnered together on this one. Borrowers down in Florida. They were looking for a $170,000 loan. So each put in $85,000 for a 6-month term, 2 points and 12%. As partners, what we did was we just split up the points, and then we split any extension fees. And then every month we received monthly payments of $850. And so at time of closing, whenever we fund a loan, we do what we call net fund. And so when we send it into the title company, we just hold back the points and the prorated interest for the first, 30 days or whatever it might be, whatever proration needs to be done. We hold all that. And we realize that at the day we fund the deal. So it's, again, another added security that we're going to at least make some money, because we made it once we funded the deal. So this one, each person, we ended up making $13,600 for an annualized return of 16%. And then a transactional loan. These come up, they don't come up as often, but these are some of my favorites because, again, that speed and velocity of money. If you're doing strictly transactional loans, you can turn the same money several times within a month sometimes. So this was somebody that needed $300,000 for 10 days. So we charged them 3.5 points because there was really not a lot of days to make interest. And then beyond the 10 days, we were going to start implementing then an 18% interest rate if it went beyond the 10 days. And so we net funded the points at the time of the funding, and so we actually ended up wiring in the $289,500, and then we made a return of $10,500. And that one went smooth. She paid it off, on the 10th day, and no issues. These are the types of transactions that are out there, and that come up. And let me see if I do have another one. I'm sorry. So this is a fix and flip loan in Tennessee. This is, again, some of these prices. They purchased the property at $40,000. And we did a $150,000 loan, so the remaining $110,000 was going to be in draws for renovations. And what was interesting on this property, and I like this one because this was a really fun one. We want to do more like this too. But the borrowers cleaned out the property. They used the $40,000 towards the purchase price. They cleaned it out, started doing demo. I think the sellers had actually stayed in it for 30 days as well. And other investors approached them, saw them cleaning it out, and offered to purchase the property from them for a profit. So they came back to us within, basically 90 days, and it was a 180-day term, and said, we need a payoff. And I kind of looked at them and said, we haven't even done any draws for the renovations yet. What do you mean you need a payoff? And so they paid us off early, but the points and interest were all based on the whole full 150. It's what we call Dutch loans. So we charge interest on the full loan amount, even though they hadn't used all those funds. And so we funded in $40,000 minus our fees and everything, so $37,000 at closing. The borrower paid 3 months worth of interest at $4,500. So $7,500 in 3 months, and we only ended up funding the $37,000 out of that deal. So it was a really good return for us, and the borrowers were super, super happy as well, to be honest with you, because they made a profit on selling it, to somebody else who actually ended up being the ones to flip it. So there's a lot of interesting types of deals out there that can be done and can be very lucrative. I use some of these because they're just various scenarios that have come up, but most of the loans, a lot of times you're going to see, let's just call it $100,000. You're going to maybe charge 1 or 2 points, and then you're going to charge maybe, let's just call it 12%. And it might sit out there and they're just making you monthly payments for 12 months, and you set it and forget it. As long as the payments are coming in, everything is good. So, a lot of the loans, I'd say the majority of the loans we do are going to just be that, where they're sitting out there for 5, 6, 7 months, and they're just making their monthly payments. So I think that's all I have in as far as the case studies. And, just kind of want to kind of go over, key takeaways that I would say is that, private lending definitely diversifies your income with high returns. And what I like is, you can partner like I do with other people and, be able to fund bigger, larger deals and yet, put how can I say, spread out your money and not have it all in one loan, but have it in maybe multiple smaller loans. But the most important part is making sure that you understand the borrower you're getting involved with, the market, and the deal, and ensuring that you have all the proper paperwork and securities and safeties in place so that your money is protected. And honestly, I could say probably the best tool to use is a self-directed IRA or a 401k. And that's about it, all I really have. I wanted to see if there's any questions, and then I do have information that I do have an upcoming 2-day workshop. So if you want to really dig into, much deeper of these types of things, and I'm certainly here for questions and answers now. March 5th and 6th, I'm going to do a 2-day workshop from 12 to 5. And actually, for people on this call, we'll do it for $497 for both days. So this is a pretty good deal because we will walk you through how to set up your lending box, how to vet the borrowers and the deals and all those things. And then I will also hold your hand through your first deals.
Good stuff. Thanks for sharing all that.
I do also have a book, and I will stop sharing. Oops. How do I stop sharing? Did I just stop sharing? Hold on. I do also have a book that you guys can download for free. So if you go to opportunityenterprisesllc.com/get the book, there's a free book that covers all of this again in much more detail as well.
All right. We do have some questions. Sheri, well done. First of all, I have my own questions, but we'll get to the audience first. What was the URL to sign up for that workshop?
Actually, if they go to the opportunityenterprisesllc.com, if they scroll down towards the bottom where you get the book and all that, it should have a spot where they can sign up for the wait list. And
okay.
that would be the next one that's coming.
I'm gonna type it into the chat. I just want to double check. Yeah, I did. Okay. I just want to make sure I spelled it correctly.
And
first,
they can email me if they have any problems too.
Cool. Yeah, good job. Okay, let me scroll back up. There's a few questions. I was kind of answering some along the way, but let's see. There was okay, Sonny, I think, was asking, I think I answered his question because it was more related to the IRA 401k. Okay, John has kind of a long thing here. I'm a client of Sense Financial and my IRA owns some land. I'd like to construct on the land. I have a pro forma. It's nearly fully entitled. Okay, I've found that non-recourse lenders won't lend on construction and hard money won't lend without recourse. Okay, everyone gets excited about the numbers. All right, here's this question. What is the best way to bring this deal to private investors? Can you hear me, Sheri?
Yeah, yep.
Okay. Yeah, John, I think that's on your end, bud, because Sheri can hear me. So John just said I can't hear you, but you can check the recording. So John is saying, what is the best way to bring this deal to private investors who are interested in loaning via their self-directed retirement plans? Effectively, what is the best way to solicit investors who want to make loans like you are discussing?
Right. Well, and I would say the best way to solicit that is, you want to get together I'll say sort of a full package, right? So you want to be able to show any lender the price that you paid for the property, what your plan is for the property. They want to see that you have permits or you have the ability to do what you want to do, because you're talking about construction, I think is what he said, right? So you want to find, we're going to want to know that you can do what you can do. So you're going to want to have a full package put together in maybe a Google Drive or something like that. And the more information, who you are, what kind of deals you've done, and then again, what you can do, your scope of work, everything you're planning to do with the deal. And then really from there, I would say reaching out to private money lenders. There is something called AAPL, which is American Association of Private Money Lending. And I think there's ways to reach out to them to see if there's lenders that might be interested in something like that.
There you go. Okay. What was that company or URL that you just mentioned?
It's AAP, American Association of Private Money Lenders.
Okay.
I'm not sure if it's AAPL.com, but they're national.
There you go. All right. Another thing too, John, is, go visit your local real estate investment meetups. there's always people looking to place money there, and sometimes they give you an opportunity to kind of stand up in front of the crowd and pitch an
Yes.
opportunity. So you never know what you'll come up, and somebody there may have a solo 401k with checkbook control that can write a check right on the spot. You just never know.
Well, and I will say that that's my first couple loans. I didn't know how to find a private money lender, and I went to a RIA and I stood up during their wants and needs, actually in San Diego, California, and somebody pulled me aside after the meeting, and he's been a lender for me. Well, I don't do it flipping anymore, but he's been a lender for me ever since. So yeah, I would say definitely go into your local RIAs.
All right. Okay. I think that's everybody. Type in more questions if you have them. I think I covered everything. One was just 401k specific, so I handled it.
Gotcha.
But I was curious. You mentioned mortgage versus deed of trust. So do you have a preference on judicial versus trust deed states, or you're kind of open to either one?
No, I try to stay away from the judicial, like more lengthy. So I don't do a lot in like California. I try to stick to the like Georgia, you can foreclose in 3 months, South Carolina is a little tricky, but I try to find the ones, the states and the areas where you can foreclose quickly and
Gotcha.
not have it drawn out. You don't have to
Yeah.
go through all the attorneys and all that kind of stuff.
Yeah, it makes sense. I mean, California is the deed of trust state primarily, and so, but it
Yes.
still takes a long
But
time.
it's a foreclosure, yes.
Yeah.
So that's the thing. It's not so much deed of trust versus mortgage, but like
Yeah.
Florida is another example of I will do mortgages in Florida. However, the foreclosure process in Florida is one of those ones that could take a year or more.
Oh, wow.
So I don't do as much in Florida as I would in say Tennessee or Georgia, that kind of thing. So
Gotcha. Yeah,
yeah.
that's surprising. Okay. The other thing you mentioned too, I just wanted to hit on this. Yeah, John keeps saying he can't hear me. I'm not sure why. You can hear me okay, obviously,
Yeah.
right, Sheri?
Yes.
Super weird. I don't know. Not sure, John. That's strange. Hopefully everybody else can hear me in the recording too. You mentioned not loaning, being careful who you loan to because, they might come back and ask for personal favors. And so I just want to be clear about, okay, thanks, Jim, for clarifying that you can hear me. So John, I think that's on your end. I'm not sure why. You probably can't even hear me say that, so it's irrelevant. But the solo 401k and IRA has to be investment only and arm's length transactions. Okay, so you and your immediate family cannot be transacted with or benefit from anything that your retirement account is doing. Now, if it's your personal money, you can loan to whoever you want. But I want to talk about what Sheri said just for a moment. Loaning to a brother who's not a disqualified party to your retirement account, or even doing that personally, is probably not a great idea. And furthermore, for your retirement account, you're the fiduciary of the plan. Your IRA 401k is not you, and you are not your 401k or IRA. You are managing somebody else's money. So make your decisions accordingly. Also, even if it's your personal money, you're the steward of that money. Your job is still to grow it, invest it wisely, whether it's IRA money or not. And so make the right decisions. I think that's really important what you said, Sheri. Nobody wants awkward Thanksgiving dinners because you had to
Yes.
foreclose on your cousin, and that's
Yeah.
really strange, right? So I don't know
Yeah,
if you
you
have
just
anything
gotta
to
be really
add on
careful
that,
with
but
those, for
go
sure.
ahead.
Yeah, no, I was gonna say you have to be careful of that. That's why I kind of put that in there. It's like you don't want to. It could be your best friend, and I think money tends to ruin a lot of relationships, right? So just be careful if you're going to go down that path.
Yeah,
Right?
exactly. And then I was hoping maybe you could clarify the holdback you mentioned. Even if there's
Yeah.
a default, you're still getting something. Because I was a little confused. Because to me, it seems like if I loan 100,000 and I hold back 3,000, 3 points, how is that me getting something if they never pay back the other 100,000? So I was a little unclear on that.
Yeah, well, that's true. So you really didn't get anything if you don't get your $100,000
Yeah.
back. I guess if you're going after the full 100,000, you have $3,000 technically of money you've made, right, in the points or whatever that's in your pocket that you could use that towards starting the foreclosure process.
Gotcha.
And you're still going after the full 100, right?
Sure.
Even
Sure.
though you only lent out 97,000. Does that make
Right.
sense? But you're right. You're not making any money if you lose 97,000 because you kept three.
Yeah. No, I gotcha. But
It's
it's
just
not.
you already have one payment that you know you're getting, so it's one less payment. You have to sit there and go, okay, am I going to get my payment?
Yeah. Got
You're
it.
realizing all that on the front end. And I do advise anybody who's doing loans to get monthly payments. Now, in self-directed IRAs and 401ks, a lot of times the benefit is you don't you're not using the money so you could say, oh, I don't need any payments, don't pay me till the loan is due, and you just, defer all the payments. However, the first way you are going to know something is going wrong in the property and on
Early
that
on.
is if they miss a payment. So if you're not getting payments, you're not going to know till it's too late. So if you're getting monthly payments and a payment is missed, you can certainly reach out and go, hey, what's going on? Let's have a conversation and try to get ahead of it before it becomes a bigger issue.
Yeah, that's a really hot tip. I love that.
Yeah.
Cool. All right. Well, I'll give you the last word. Anything else to add before we shut this thing down?
No, I mean, again, this is a little bit more of a, I'll say, sort of kindergarten, first grade level. But, definitely feel free to reach out and get my free book if you want to dig in a little bit deeper there. And then we do have the workshops, if you really want to get more, because there's a lot to lending as far as protecting it and make sure you're doing it the right way. So.
Yep. And what's your email address, Sheri, that you want people to email you on?
Yep. It's Sheri, SHERI, at real, or actually, let's do Opportunity Enterprises, LLC.com.
Okay, I'm going to put it in the chat, LLC.com. Enterprises Sheri at Opportunity Enterprises, plural, LLC.com. Okay, cool. All right, yeah, hit her up and, jump on a call with her, ask her questions, sign up for her workshop, whatever it is. I'm not telling you to do business with her. I'm just providing value by bringing her on as a guest. And we do appreciate that. So, and thank you everybody for joining us. And Sheri, a special thank you to you for taking your...
Yes, and thank you. Thanks for all you guys do. And thanks for having me on. I appreciate it. Take care. All right. Bye-bye.